Look, there was real strength in the quarter that you reported, and analysts are saying that time and time again, particularly in loan origination across the board. But, well, many are saying, look, you uncharacteristically didn't raise your revenue outlook. What held you back from doing that?
Yes, we had a record quarter. Actually saw accelerating revenue growth to 41% year-over-year growth and reported over $1 billion of revenue. Our view was we went into the year with a view that we'd have at least 2 rate cuts, and that was one of the key assumptions to our outlook for revenue guidance. And while we beat the quarter, we're not raising full-year guidance because we now expect no rate cuts, and that will be a more difficult environment to operate in than if we had 2 rate cuts. The business is performing incredibly well. I'm not sure there are many companies that are generating over $1 billion of revenue with 41% growth year-over-year and 31% EBITDA margins. We like to look at the rule of 40, which is revenue growth plus EBITDA margins, and we've had more than a rule of 40 for 18 consecutive quarters, including this quarter, and we're still forecasting that. But we saw no reason to raise guidance in this environment, given the uncertainty as it relates to markets and interest rates, as well as global issues with the Middle East and the pressure on oil and inflation generally.
A lot of macro headwinds that you're navigating. What about, in particular, private credit, Anthony? Because I'm looking at the slowing volume in the loan platform business. You said it's not because of that, but still analysts are kind of worried about it.
Yeah, I think generally when you don't raise guidance, you give people something to worry about. So we had record personal loan originations, $12.9 billion, record student loan refinancing originations, and record home loans. And in fact, our home loans business doubled year over year, as did our student loan refinancing business. The loan platform business is one where we produce loans for other partners, and that business was very strong. It wasn't as strong as it was prior quarters because we made the conscious decision to put more of the loans we originated on our balance sheet because we had capital to do it. Those loans will produce cash flow over the next 3 years, as opposed to the loan platform business where we just generate revenue in this quarter. We're not seeing any issues with credit performance. It's been quite strong. The concerns about private credit are really not appropriate for our business. Our partners in the loan platform business are buying consumer unsecured loans from us, not financing companies with corporate debt.
Your goal is to kind of be this one-stop shop, particularly for the category of young and affluent, right? We talk about that a lot with you on the program. Sure. You didn't call out the economy this quarter. Forgive me if I missed it, but in the call, you didn't call out the economy. And a lot of people are looking at how solid credit quality signals are. Your borrowers are holding up. Would you tell me a little bit about how you see the economy, but particularly people that are young and people that are affluent?
Sure. We're not seeing any economic headwinds for our consumer. As you mentioned, they're younger, they're mass affluent. We saw very strong trends in spending through our debit interchange revenue. We also saw strong trends in investing. Our investing business doubled on a year-over-year basis. And we're also seeing strong trends in performance in our credit card. So as we think about the breadth of our businesses and the activity that we see, we're seeing no slowdown in consumer spending, consumers' ability to deliver the obligations they have on their debt, or their desire for more products like invest. So no issues whatsoever with our underlying consumer or their profile. I think the concerns about AI creating unemployment among white-collar workers is a lot of hype. We're not seeing it in any of our businesses.
You're a technology company, but you also have this goal of being a top 10 financial institution, or so Bloomberg Intelligence writes. You have that goal. When you talk to the team internally, how do you hold yourself on milestones to get to that? When will you decide, Anthony, that, yeah, you know what, today we are a top 10 financial institution?
Sure. To be a top 10 financial institution, it's measured by market cap. We've seen a great increase in our valuation over the last 8 years that I've been here. When I arrived, our capitalization was private, but the value of the company was on a common stock basis, was in the $2 billion range. We're now well over $20 billion of market cap, and so we're on our way there. We've made great progress in that 8 years. We've taken our member base from 650,000 members to $14.7 million this quarter. Our revenue from about $250 million of revenue to last year over $3.5 billion, and on our way to $5 billion in 2026. But ultimately, we'll measure it based on market capitalization, and I think we're in rarefied air, growing 41% year over year with over $1 billion of quarterly revenue, and as I mentioned, 30+% EBITDA margins. So it's just a matter of when, not if.
And we're looking at the 20+% increase in the share price over the last year, but today it's down by $3 billion. Does that frustrate you, the day-to-day gyrations, if that's how you're measuring yourself in terms of making the top 10?
I think it's just the reality of the investment markets. The markets do not like uncertainty. We're not raising our guidance for the full year. People think there's some degree of uncertainty. Well, the outlook for the market is different today than what it was when we gave guidance 3 months ago. If the interest rates do actually come down, we'll see a big pickup in our business that would cause us to be more bullish than we already are. It's not like we're growing a very slow rate even on our current guidance. Our current guidance calls for 30% plus revenue growth and 30% margins. There just aren't a lot of companies with $1 billion of quarterly revenue growing 30% with 30% margins. So we're focused on 2 things: driving durable growth through product innovation and brand building, and then delivering great returns. And that's what we continue to do. And so I understand why people are concerned about the outlook, because we're going to raise guidance, but the world is changing every day around us. We're executing incredibly well. Our goal is to generate escape velocity so that we're the winner that takes most in the industry. As you mentioned, we're in everything digital financial services app. That's in place. The brand building's in place. The execution's in place. We just have to keep delivering, and everything else will take care of itself.